The Berlin Wall fell, the Soviet Union crumbled, and the Cold War was over. Gas prices were cheaper than they had been since World War II, and supply appeared ample. According to Francis Fukuyama, the 1990s marked the end of history with the ideological victory of liberal democracy over communism. This era witnessed relative oil price stability and economic growth. But perhaps this was due to chance more than anything else. For example, even though the collapse of the Soviet Union sunk global oil demand by 4.7 million barrels a day, China's demand doubled, balancing out this potential destabilization. Venezuela, meanwhile, ignored OPEC quotas and produced in full. This also should have destabilized the market, but a mysterious price spike in 1996 tempered this. To this day, nobody quite knows how. Due to this steadiness, the Clinton presidency regarded oil with nonchalance. US dependence on foreign supply did double since 1985, but in 1996, the US actually sold some of its strategic petroleum reserve to cover budgetary shortfalls. And what is more symbolic of the 90s than the fuel-guzzling SUV? In Asia, strong economic growth attracted major capital inflow, but this formed a real estate bubble. In July 1997, Thailand's currency, the baht, crashed, triggering a wave of currency devaluations and bankruptcies across the continent. Initially, OPEC disregarded the Asian financial crisis and approved a November quota hike. But global oil demand plummeted, fostering enormous oversupply and demolishing oil prices. This was a stunning misstep for OPEC. Saudi Arabia, Venezuela, and Mexico subsequently cut oil production in March 1998. After prices didn't improve, the rest of OPEC, including even Iran, then instituted a second round of production cuts. But demand, and thus prices, only began recovering in 1999. In March 2000, OPEC aimed to keep crude within a price basket of $22 to $28 a barrel. Producing and consuming economies alike regarded this as a healthy range. But the global economy deteriorated again throughout 2001, prompting OPEC to cut production in March and July. Then, 9/11 struck. While oil prices briefly spiked, they dropped below OPEC's price window to $17 a barrel by November, even after the US invaded Afghanistan the month before. The return of oil price instability forced energy to take center stage during the Bush presidency. The US even refilled its strategic petroleum reserve to capacity for the first time ever. And guess what, Francis Fukuyama? History continued. In March 2003, a US-led coalition invaded Iraq for a second time, allegedly to find weapons of mass destruction and to free the Iraqi people. Fake news much? After all, Iraq had nationalized its oil industry in the 1970s, and more recently signed contracts with China, Russia, and others to develop new oil fields. US companies were left in the cold. Add to the war a Venezuelan oil strike and the election violence in Nigeria, and almost 3 million barrels a day fell out of the market between November 2002 and April 2003. Oil prices were up again. As demand arced upward, would supply ever catch up?